first. Now, what happens with the stock market ultimately is anyone's guess. To see all the people, all the big money moving out, to me, is very dangerous. But I think you will see cryptos, precious metals, those things are going to do very, very, very well. Hard assets, in particular, will do very well, because these are things that will protect you as your dollar is losing purchasing power. And, commodities right now are historically undervalued related to financial assets. So I would argue they're really the ones that are poised to break out. And with debt exploding, something is about to break as far as I'm concerned. So the Fed will print again, and real stuff like gold, silver will soar. This is a big deal because the financial system is very low on cash.
Andy Schectman, CEO of Miles Franklin, points out a major shift happening in precious metals. COMEX deliveries are hitting record levels, and it's not retail buyers behind the move, it's governments. Saudi Arabia, China, Russia, and India are quietly stockpiling silver, treating it less like a commodity and more like a strategic resource. Saudi Arabia's stake in SLV even gives them the right to demand physical delivery, a privilege small investors simply don't have. What makes this even more striking is who isn't involved. Retail investors, despite their growing wealth, hold almost no gold or silver. The run-up we're seeing hasn't been fueled by small buyers chasing headlines. It's been driven almost entirely by central banks, sovereign wealth funds, and large institutions taking delivery of real metal. Schectman argues that if this were anywhere near the top, the public would already be flooding in. Instead, they're still on the sidelines. Meanwhile, the financial system itself looks fragile. The Federal Reserve's reverse repo facility, which once stored over $2 trillion in bank liquidity, has collapsed to just $28 billion. That cushion, the emergency cash buffer of the system, is basically gone. According to Schectman, the Fed has no real exit strategy. Eventually, it will be forced to print again. When that moment comes, paper assets won't be the safe haven people assume. Stocks and bonds may struggle, but scarce, tangible assets, gold, silver, commodities, and even crypto will surge. That's why the world's biggest players are already positioning themselves. They know where this is heading, and they're moving long before the average investor catches on. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Yeah, the deliveries on the COMEX are extraordinary, Elijah, as are the offtakes off the COMEX exchange, which are extraordinary. These are very, very much aberrations. They're anomalies. We don't see them very often, or never have until recently. And I remember talking with your dad in 2020 about all of a sudden all of these deliveries coming into COMEX. They've only increased 100-fold. But when you talk about trends, Saudi Arabia is now, to my mind, the third government next to China and Russia who are, well, maybe let's call it the fourth, India. India, China, Russia, and Saudi Arabia now. And again, these are all, these are members, whether admitted or not. Saudi Arabia is, in essence, in my mind, pretty darn close to a BRICS member in that they are a full participant in the Enbridge technology. They are going to all of the BRICS meetings. They are very much have one foot in and one foot out to appease the West, but by all of their moves appear that they are going lockstep with the BRICS movement. They took a major stake in SLV, the silver ETF recently, and enough to demand physical delivery. Now, they haven't done it yet, but you have to have a certain amount, like it's a basket, huge amount, millions and millions and millions of dollars worth, in order to be able to demand physical delivery. This is a privilege retail investors do not have. They will. I find it interesting. We've talked at length about China flying around the world and buying doré and concentrate directly from the miners in South America and Mexico. We've talked about India buying over 800 million ounces in the last 5 years. We've talked about Russia making it part of their national stockpile, which we'd never heard before from a government, and now Saudi Arabia is doing just that. And so when you realize that India, China, Saudi Arabia appear to be publicly accumulating silver under the guise of industrial uses, it's a lot more than industrial. Silver is really more strategic than it is industrial. You mentioned billionaires. David Bateman is the one that comes to mind. He came out recently and said, that just a 10% shift from gold to silver, where all the people investing in gold, if 10% moved it to silver, it would consume all newly mined silver globally. This is, implying a potential massive squeeze. He said, one billionaire won't do it, but 10 would. Or a 10% shift out of gold into silver. When you see governments like Saudi Arabia come into the fray, you know that it's coming. I found it very interesting. One of the things that I talk about a lot when we talk about the public not holding any gold, very little. My standard phrase I copy from Rick Rule. He says, from Joe and Jane Sixpack to the Harvard Endowment Fund, the average of gold owned by the public and gold-related equities is 1/2%. Well, lo and behold, the Harvard Endowment Fund just bought $101.5 million in GLD recently. And so now you have all of these institutions jumping into accumulating precious metals. Now, these institutions, I don't know how much they understand the difference between GLD and the real thing, but you look at Bass, his last name is Bass, I forgot, his Kyle Bass, I think is his name. When he was running the hedge fund, I think it was for the Texas the Texas Teachers Union, or it was a big fund for that. I believe that's what it was. It was a long time ago, maybe a decade ago, but he put all that money, like $1 billion into GLD, and they took possession of it as well. So I don't know if he intends to do this, or they intend to do this time, the Harvard Endowment Fund. But the very fact that they're buying $101.5 million in GLD tells you that gold and silver are becoming more mainstream, certainly more mainstream. And I think you'll see at this upper level on COMEX, sovereign wealth funds, endowments, that's one step away from the public, who is still kind of blissfully, whistling Dixie, not really understanding the significance of this. But the people who are very, very tied in to what's happening globally are making moves and standing for delivery. It's a big deal. To see the Harvard Endowment Fund jump into this degree is a very big deal. We're nowhere near the top because the public has no understanding of exactly what is happening. This has been driven by central banks primarily, and big money, and whoever is taking possession here in the United States. But the public is nowhere near even entered into this at all. So no, I think that, to see a market move the way that it has without the public involved is rather telling. To see, what amounts to north of $100 billion delivered into the COMEX that we know of since the beginning of the year, what does that tell you? I mean, this has never happened before. And to see a lot of it leave the exchange, this has never happened before. And people at that level don't make moves like that unless they know something is coming. And I do believe that. I really do believe that. And so I guess I would say we're nowhere near the top. When you see, like, to your point, everybody talking about it, and everyone having allocation to it, well, it may be time to start thinking about this. But not only that, we're looking at lower interest rates coming, which of course benefit asset prices. And so this locks out average people, as far as I'm concerned, because the average people, they don't own assets, and assets are what make the wealthy. Because, as they're going to choose a path of inflation, you're going to see everything pop up. You see stocks, real estate, bonds, gold, silver, all of these things are going to surge, in my opinion, at least at first. Now, what happens with the stock market ultimately is anyone's guess. To see all the people, all the big money moving out, to me, is very dangerous. But I think you will see cryptos, precious metals, those things are going to do very, very, very well. Hard assets in particular will do very well, because these are things that will protect you as your dollar is losing purchasing power. And, commodities right now are historically undervalued related to financial assets. So I would argue they're really the ones that are poised to break out. The system is under stress, Elijah, and it seems that to a degree reality is catching up. That's why the insiders are doing what they're doing. They do it long before the rest of us figure it out. As you're looking for that, another interesting thing that's happening, is the reverse repo market, which we talked so much about a year ago, has dropped from $2.2 trillion to $28 billion. That's a 99% draining of bank liquidity. And in essence, there's no cash left in the system. And with debt exploding, something is about to break as far as I'm concerned. So the Fed will print again, and real stuff like gold, silver will soar. This is a big deal because the financial system is very low on cash. And so when big institutions used to keep their money there, over $2 trillion with the Fed for safekeeping, now there's only $28 billion left. That's like a giant emergency fund that's been drained. And as far as I'm concerned, the U.S. Treasury, which is now flooding the market with bonds to cover its record spending, all that debt sucks cash out of the system, and now there's not much left in the system. So you're going to get big players like hedge funds and other leverage investors who borrow too much, who are going to find it very difficult to find cash. And if they can't pay their bills, they'll start selling everything, which could crash part of the market. So I would say to you, yeah, this has never been more important ever to own hard assets right now. And this is another reason certainly worth talking about.
Andy Schectman says Jerome Powell has effectively waved the white flag in the fight against inflation. By abandoning the 2% target, the Fed is signaling that inflation is not under control and likely never will be under current policies. Instead of tackling price stability, the focus has shifted toward labor numbers, data Schectman calls deeply flawed. Recent revisions wiped out hundreds of thousands of so-called new jobs, revealing that the labor market is far weaker than official reports suggest. This shift sets the stage for a stagflationary environment, higher inflation paired with a slowing economy and rising unemployment. Schectman warns that cutting interest rates now only worsens distortions. Artificially low rates inflate asset prices, enrich the wealthy who already own assets, and punish ordinary people who face surging costs for housing, food, and fuel. Lowering rates, he argues, won't help new homebuyers. It will make homes even less affordable. The root problem is that markets no longer determine the cost of money, central bankers do. By interfering, they create misallocations of capital, bubbles, and systemic instability. Meanwhile, official inflation numbers are misleading. Independent sources like Shadowstats estimate true inflation closer to 11%, far above the government's reported 2 to 3%. Rising producer prices confirm that the cost pressures are accelerating, not easing. For Schectman, the outcome is clear. The wealthy will see their asset values surge while the middle and lower classes struggle just to keep up with living expenses. Rate cuts won't fix the problem. They'll light the fuse on even higher inflation. Let's get back to the interview.
Well, I think that one of the things that I found very interesting coming out of that meeting, Elijah, is that Powell has more or less waved the white flag, if you will, against the battle, with the battle against inflation, and confirmed that they will no longer aim for their silly inflation target of 2%. Shift away from these dovish policies tied to I guess you could say, trying to pretend that inflation is under control. It's not under control, and I think really what they are looking forward to or trying to do is focus more on the labor numbers, which are ridiculous in and of themselves. When we saw, I don't know how many hundreds of thousands of jobs that were adjusted downward from May and June. And so in essence, it's a shift away from inflation expectations and now tying it directly to the labor market performance. I think what you can expect to see in that respect would be much higher inflation. And it's interesting that they're talking about lowering rates heading into what seems to be a very stagflationary environment where unemployment seems to be increasing. The numbers which we were told that represented strong labor numbers were a farce. And inflation really is far worse than what they are saying, as far as I'm concerned. You're talking, I don't know when the last time we've had a 2% monthly inflation number, and they'll never hit that target. So in essence, what you could expect would be much higher prices into a very weak economy. And, they talk about this being a benefit for home prices as an example. Well, lowering rates isn't going to benefit new home buyers. It's only going to make the problem worse. That's what got us into this problem to begin with. So yeah, I think that the last thing really that this economy needs at this point, as far as I'm concerned, is lowering of interest rates, because it gets us right back into the same problem that we have been in all along, which is distortions of interest rates. The market should set the interest rate, not the bankers. And by allowing the bankers to do this, it's distorting asset prices. It's creating imbalances or misallocations between resource and capital. And this is the problem that we've seen over and over and over and over again. And that is not letting the market control the rate of interest and the cost of money, but thinking the bankers know best. They're late, and even doing it now at all, to me, is the wrong thing. This is the problem. We're boxed in, and they feel that they need to do this. But in essence, all we're going to do is distort things even worse. The rich are going to get richer as asset prices are going to go much higher. The economy is already slow. So for people who have already lost their job, or the lower income folks, are going to see much higher asset prices, or much higher prices in just the necessities that they need. So the wealthy get wealthier because they own assets, and the poor who don't own assets will find it harder to put food on the table, to drive to work. You're just going to see an uptick in inflation and an economy that is shedding jobs. The Bureau of Labor Statistics, the BLS, should just be called what it is: bullshit, BS. And the numbers that come out of there, whether it be unemployment or whether it be inflation, have misled the public for a very, very long time. And the numbers that they're telling us on inflation are actually much, much higher. You know this. Your dad knows this. We've talked about John Williams and Shadow Stats. He's been on your show, and he would tell us inflation's actually closer to 11%, not the 2.5%, almost 3%. The producer price index shot up last month, and again portraying higher and higher inflation. And really, this is going to light a fuse, if you will, under the costs of living expenses for the average American person. It's not going to do much to help the average American. What it will do is it'll benefit the upper 1% who have lots in the way of asset prices. Well, when you talk about Fed independence, it's really a lie. It's a farce, because you got Stephen Miran, who is the author of the Mar-a-Lago Accord. He's taking over supposedly for the position that's vacated. And now there's another Fed board member who is being investigated for mortgage fraud or something along those lines. Trump is calling for him to step down. You're going to see more people put into the Fed that will do the tidings of the current administration. There really is no independence right there. But what it really signals, I think, to the rest of the world is that holding dollars is very silly, that if you hold dollars, you'll end up going broke, because it's very clear. The Mar-a-Lago Accord and Stephen Miran's plan is to devalue the dollar. I've been saying that on your dad's show for the last 2-3 months, that their whole plan is to devalue the dollar tremendously. And so whether you call it independence or not, the folks that are being put on the board who will make the decisions, I believe, will make the decisions in line with what the administration wants. There is no independence. But this is all part and parcel for why you're seeing de-dollarization. Holding your assets in dollars is the surest way to go broke in an inflationary environment. The dollar's already down 11% so far this year. And this is a trend that I think will continue, not only just through de-dollarization, but also through the plans of this administration to have a weaker dollar with the intention of having it spur on manufacturing demand in this country, which is ultimately, I think, what they're saying they're trying to do. So yes, in an odd sort of way, it will enhance de-dollarization. And even though it appears outwardly that there is independence, the folks that are being put on the board are anything but independent thinkers. They will toe the line with the current administration. So it's just smoke and mirrors once again.
What's happening in the global markets has the feel of a quiet but deliberate repositioning of power. Large state players and institutions are steadily pulling real wealth off the paper exchanges, signaling that confidence in fiat-backed promises is slipping. At the same time, policy signals from the Federal Reserve point to an uneasy surrender. Inflation is tolerated rather than contained, labor data looks less reliable than ever, and the very idea of price stability has been pushed aside in favor of political optics. The end result is a two-tiered financial reality. On one side, the powerful accumulate resources that hold value when trust in paper weakens. On the other, everyday savers remain distracted, left holding assets that depend on a system already showing deep cracks. History shows that such gaps rarely persist without a dramatic correction. Will the next chapter mark the moment when tangible assets reclaim their place at the center of wealth preservation, leaving those who hesitated scrambling to catch up? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.